Do you honestly think Warren Buffett built a $900 billion empire because he has a higher IQ than you? Or because he has some secret supercomputer hidden in Omaha that predicts stock prices? Wrong. The secret has nothing to do with being a genius. It has everything to do with avoiding stupidity. The late Charlie Munger, the legendary architect behind Berkshire Hathaway, famously said, "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent." Think about that. While everyone else on Wall Street is trying to be the smartest guy in the room, solving complex equations and chasing the next AI revolution, Munger and Buffett just focused on not blowing up. Today, we are going to decode the anti-stupidity algorithm that ruled the financial world for 60 years. If you want to outsmart the market, you don't need to learn rocket science. You just need to learn how to stop tripping over your own feet. Let's get one thing straight immediately. Warren Buffett calls himself the general contractor, but he calls Charlie Munger the architect. Why? Because before Munger came along, Buffett was actually investing the wrong way. Early in his career, Buffett was obsessed with what he called cigar butt investing. Picture walking down the street and finding a discarded cigar butt on the pavement. It's gross, it's soggy, but it has one free puff left in it. Buffett would buy terrible, dying companies just because they were cheap, looking for that one last puff of profit. It was Munger who grabbed Buffett by the shoulders and essentially said, "Stop buying garbage." He convinced Buffett to pivot. The new philosophy was simple but revolutionary. Forget fair companies at wonderful prices. Buy wonderful businesses at fair prices. Without this pivot, there is no Coca-Cola investment. There is no Apple holding. There is no Berkshire Hathaway as we know it today. Munger understood the math of quality. If you buy a mediocre business, time is your enemy. You need to get in and get out before the ship sinks. But if you buy a wonderful business, something with pricing power, a massive moat, and a loyal customer base, time becomes your best friend. Think about Apple. When Berkshire started buying it, it wasn't a bargain bin stock. It wasn't cheap. But Munger knew that holding a quality asset allows compounding to do the heavy lifting for you. If you are holding trash stocks hoping for a quick bounce, you are fighting against gravity. Munger didn't gamble on luck. He bet on inevitability. He knew that over a 10 or 20-year horizon, quality crushes mediocrity every single time. So, how do you actually apply this? How do you filter out the noise? Munger gave us a mental framework that is arguably the most powerful risk management tool in history. It's called inversion. In World War II, Munger served as a meteorologist. When he was trying to figure out how to keep pilots safe, he didn't ask, "How do I save these pilots?" That's too vague. Instead, he inverted the problem. He asked, "What would kill these pilots?" Quote, "The answers were concrete. Sending them into icy conditions, letting them run out of fuel, or having them fly with mechanical failures." So, his entire strategy was just to ensure those specific things never happened. If you avoid the things that kill you, survival, and eventually success, is the only thing left. In the stock market, you need to do the same thing. Don't wake up asking, "How do I get rich this year?" That question leads to speculation and gambling. Ask yourself, what will bankrupt me? What will wipe out my portfolio? Identify those disasters and run in the opposite direction. Munger identified the 3 biggest ways a smart person goes broke. He called them the 3 L's: liquor, ladies, and leverage. Now, Warren Buffett liked to joke that Charlie only added the first 2 because they started with the letter L. But the elephant in the room, the real killer in modern finance, is that third one: leverage. Borrowing money to trade. Leverage is a double-edged sword that usually cuts your head off. When you trade with your own money and the market drops 50%, you can just sit tight, drink a coffee, and wait for the recovery. But when you use margin, you lose the ability to wait. A 20% drop triggers a margin call and you get wiped out right before the market bounces back. Munger always said, if you're smart, you don't need leverage. And if you're dumb, you have no business using it. To finish first, you must first finish. Leverage takes you out of the game completely. But there is a 4th wealth killer that Munger hated even more than leverage. It's the psychological trap that drives the entire modern economy: envy. Munger famously said, "The world is not driven by greed. It's driven by envy." In 2026, this is worse than it has ever been in human history. You open your phone and you see a 20-year-old on TikTok who just made $1 million on some obscure meme coin or the latest tech IPO. Suddenly, your safe, compounding portfolio feels like a failure. You feel like you're falling behind. That feeling? That is the market baiting you. That is FOMO hijacking your brain. Envy pushes you to take stupid risks just to catch up with people who are likely just getting lucky. Munger's advice was brutal but liberating. Someone getting richer than you, faster than you, is none of your business. If you try to chase their returns, you are buying a lottery ticket, not an investment. The stock market is designed to transfer money from the impatient to the patient. Envy makes you impatient. It blinds you to the risks because you're staring at someone else's reward. Kill the envy or it will kill your returns. Now, let's talk about execution. Let's say you've avoided the 3 L's, you've killed your envy, and you've bought a wonderful business. What do you do next? According to Munger, you do absolutely nothing. And that is much harder than it sounds. Wall Street is an industry designed to make you trade. Your broker, the financial news channels, the guys on Twitter, they all want you to click, buy, and sell as often as possible because that creates fees and engagement. But Munger's philosophy was aggressive inactivity. He said, the big money is not in the buying and selling, but in the waiting. This is the hardest skill to master. Can you buy a stock like Costco or Amazon and then literally sit on your hands for 10 years? Can you watch the market crash, watch it soar, watch pundits scream that the world is ending, and just do nothing? Friction costs, taxes and trading fees are the termites of your portfolio. Every time you trade, you interrupt the compounding process. Munger compared investing to baseball, but with a twist. In investing, there are no called strikes. You can stand at the plate with the bat on your shoulder for years, waiting for the perfect, fat pitch right down the middle. The crowd might boo you for being boring. The crowd might scream at you to swing at the bad pitches. But you don't have to swing until everything is in your favor. Finally, you need to understand the circle of competence. On Munger's desk, he essentially had 3 baskets for potential investments. Yes, no, and too hard. The vast majority of investments went into the too hard pile. And here is where most retail investors lose their shirts. They try to force a too hard investment into the yes pile because they don't want to feel left out. If you don't understand how biotech companies' drug trials work, or if you can't explain the supply chain of a semiconductor company to a 5-year-old, don't buy it. It doesn't matter if everyone else is making money on it. It's outside your circle. Admitting, I don't know, isn't a weakness in this game. It is a superpower. It keeps you safe. Munger and Buffett missed out on Amazon and Google early on because they admitted they didn't understand tech. Did it hurt them? No. They stuck to what they knew: insurance, consumer goods, railroads, and they still became billionaires. You don't need to understand everything. You just need to understand what you own. So, here is the blueprint. It's not sexy and it won't make you rich overnight. But it works. Be consistently not stupid. Invert the problem. Figure out what kills your wealth and avoid it like the plague. Never use leverage. Delete the apps that make you envious. And when you find a great company, have the courage to do nothing for a very long time. That is the Munger legacy. It's not about brilliance. It's about discipline. Thanks for watching, and I'll see you in the next one.